The Physician's Road. Create your life in medicine on your own terms. Today, we are on the path to wealth.
The Physician's Road is brought to you by Vernonville Asset Management. Vernonville Asset Management was created to help physicians build wealth and create income beyond Wall Street. Through our exclusive private investments, doctors can begin to free themselves from the burdensome regulations in healthcare by creating income streams independent of medicine. Go to incomebeyondwallstreet.com to get your free report, Wall Street's Biggest Lie. Again, go to incomebeyondwallstreet.com to get Wall Street's Biggest Lie and free yourself today.
Hello, everyone. Welcome to the Physician's Road. Today, we're on the path to wealth, and I'm happy to have Josh Mettle here from the Physician Group at Fairway Independent Mortgage, and he is Director of Physician Lending. Now, I've known Josh for many years now. He was kind enough to have me on his podcast many years ago, and I think we had a great time on that. I think we got a lot of good information out. I got a lot of good feedback from Josh's listeners, and I wanted to be able to return the favor today and have Josh on because we have a lot of physicians out there who are going to be buying their homes or have bought homes in the past and don't realize that there is such a thing called the physician's mortgage, which can be a great benefit in your financial arsenal in terms of being able to I would like to say, stretch your dollars or have your dollars working more effectively for you. So from that standpoint, I'm going to introduce Josh and let him take it away and kind of introduce himself and tell us about his company.
Eric, thanks so much, man. It's glad to be here. And I have been a follower of your website and your writings on your blog, and appreciate the wisdom that you have shared in your email updates over the years. So glad to be here with you and your listeners today.
Thank you.
A little bit about our company. I think we started in a unique fashion where I started working with just a few physicians from the University of Utah and quickly found that they were running into stumbling blocks in qualifying due to the normal restrictions of student loans, closing on future employment income, not wanting to put 20% down on jumbo loans because they could allocate those funds to paying down debts, or they were behind in their preparation for retirement. And so we started creating some mortgage vehicles to help them get over those hurdles. A few years into the process, I was called by a young man who was literally driving across the country in a U-Haul van full of their possessions with his wife, 2 kids, and a dog. And literally on the way to the University of Utah to start his residency, he got a call from his loan officer that was from one of the big banks that were the purveyors of physician loans. And the loan officer on the other end of the phone said, we're really sorry, but our underwriter has declined your mortgage loan. And, the young physician did everything he could not to crash the U-Haul van because literally the next day he was to sign the closing documents. They were going to move in over the weekend, and then orientation for the residency started the next Monday or Tuesday. And now he was homeless with a wife, 2 kids. And how do you fix that in 48 hours and starting a grueling residency schedule? And that story, unfortunately, was not the only one that we heard like that. And what we figured out was there was a problem with the way that big banks were underwriting mortgage loans, especially physician mortgage loans. And what we figured out, how everybody, you don't really know how everybody else is doing things. You just know how you're doing things. But what we realized through hearing these horror stories was a physician would call a lender and say, "Hey, I need a loan." And they would say, "Great. How's your credit?" "Good." "How much money are you going to make?" $20,000 a month. "Here's your pre-approval letter." And they would go out and try and find a house. And unfortunately, when the employment contract came in and it made its way to an underwriter, and the application came in, they said, "Whoa, what about these $250,000 in student loans that show the 0 payment? But we certainly have to equate for those somehow in our analysis, or we have to factor that into our analysis. And this employment contract says you're an independent contractor. You're now self-employed. You don't have $20,000 a month in income. You have 0. And the problem was most of these big banks that are purveyors of physician loans weren't getting into this level of detailed analysis until somebody had fallen in love with a home and had, showed their kids, this is where your new bedroom's going to be. And as I illustrated in that case with the young resident relocating across the country, that can be a pretty traumatic experience. So what we did is we re-engineered the process of qualifying for these loans. We've compiled about 6 or 7 different loans that lend themselves to physicians and their common challenges. And we have created the conveyor belt, if you will, or the process of underwriting a loan, where we actually have our underwriting team do an analysis on the borrower's employment contract, student loans, assets, all of those factors that are going to qualifying. We have them do that before they find and fall in love with a home, so that when you're driving across the country with your family, the phone call is, hey, I just want to let you know your closing docs are at the title company, and we look forward to, make sure you have your keys tomorrow, versus your loans declined. So I don't know if I answered your question, but that's a little bit of the background on our company and why I believe we're very different than most banks.
Perfect. And so that's exactly what we wanted, because that's a good point of differentiation. And so I think you touched on it, but can we go a little bit deeper in terms of what a typical bank, when they're underwriting physicians, let's just say, and we can go at different levels, but let's just say resident, fellow, new attending, how is it that banks usually look at those types of individuals?
Yeah, it's a great question. And it really comes down to a decision based on cost for most banks. So if I'm gonna involve an underwriter who is not a cheap employee, before a client has found a home, only a fraction of those clients will actually find a home. And then they'll write an offer and it'll be accepted. And then they will decide to use us as the lender. So maybe 75% of the clients that most banks talk to don't actually end up closing a transaction with them. And so from a cost perspective, they've just decided, look, we're going to do fast, easy, cheap, low cost pre-approvals. Then once you find a home and commit to do a loan with us, then we're going to bring in the underwriter to analyze the loan and make sure we can actually do a loan for you. But the problem is, from the consumer's perspective, by time that underwriter, who's the gatekeeper of the transaction, looks at the file, you've already made a commitment that that's where you're going, and you've made plans and movers and shown your kids this is going to be their bedroom. So we just changed that process. And what we do now is we'll gather all of the employment contracts if there's a relocation involved or a new job, income, assets, credit, all of the pieces that need to be underwritten. We have our underwriters pre-underwrite that data before we issue a pre-approval letter. And then when we issue a pre-approval letter, we actually call it a credit and income approval, because it's been reviewed and credit and income approved by an underwriter. Got it.
So to make sure I'm clear in my own mind with the process of how it normally goes, is these banks might salivate with the fact that you have an MD behind your name, look at potentially what you're going to make, give you an early pre-approval, but it's really not what we call kind of a scrubbed process, where they're really doing a deep due diligence dive on your assets and your liabilities until you've agreed to go down that particular pathway with them. And basically what you're saying is you flip that process and said, you know what, we're going to do the deep dive on the front end to give you a true and accurate depiction of what you can actually afford to buy and what your company would be actually willing to extend in terms of loan.
That's exactly right. And in this market in 2018, that process is more important than it was when we came up with the process. I wrote a book called Why Physician Home Loans Fail, How to Avoid the Landmines for a Flawless Home Purchase. I wrote that book in 2014. I think it came out in 2015. And at that point, we were only in 13 states. So I wrote that book because I realized there was physicians in 37 other states that we couldn't advertise to or get to, but I wanted to get this information out so people were properly armed with the information to have a flawless home purchase. You can go to the website, www.whyphysicianhomeloansfail.com, and get information about the book there. But in today's world, in 2018, that process that you just described is so much more important, because there is incredible competition for real estate today. You well know this, that on a residential home in a good neighborhood, in a fairly priced home that's in decent shape, in many areas of the country may have 3, 4, 5, 10 different offers coming in on the house at the same time.
Absolutely.
Well, what we didn't really know about our process was, well, geez, if we do all the heavy lifting up front, then once you find a house, we can actually get you from contract to close in many instances in 10 to 17 days. So if there's 5 offers and all of the rest of those offers are with financing to close within, let's say, 25 and 45 days. I think the national average is 41 days with a finance deal right now. But let's just call it, 25 to 45 days. And our offer says we'll close in 2 weeks. What that means to the seller is, hey, if you take our offer, number one, we've done all the heavy lifting. So the underwriter's already approved the borrower, right? We just have to underwrite the collateral, meaning the property. And so it's a real offer. And number two, if you take our offer, you don't have to make the next month's mortgage payment because we're going to close and pay off your loan before you make your next mortgage payment. So why wouldn't you take our offer over the other 5? And so as an unintended consequence, a good unintended consequence, we find that our clients have a much higher level of offer acceptance in multiple offer situations because of the fact that we've done the heavy lifting before the offer was written.
So I guess in the business, we call that a unique selling proposition. So how does someone convey that to their realtor that they're using if they happen to be using you guys, right? And so how would somebody go about conveying that, you can, because I'm sure you don't want to guarantee that you can close in 2 weeks, but how is it that is communicated to the realtor in such a way that they can make that kind of strong offer that could potentially raise someone's contract to the top of the pile?
Yeah, it's a great question. We wrestled with that exact question for about 2 years. And, first we started with the buyer's realtor, just saying, look, we've done all the heavy lifting, just write a 2-week close. Then we thought, well, maybe we could call the listing agent as a lender. So we'll actually call the listing agent and say, hey, Eric, I just want to let you know I'm calling on your listing at 123 Easy Street. Dr. Johnson is going to be making an offer. And let me tell you the due diligence we've already done. The file's been through underwriting, great credit scores. We've already done all the, we tell them this is a done deal if you're willing to accept the offer from our buyer. Just in the last 12 months, we said, well, what if we could do even better than that? On top of those two things, what if we could stack the deck, really stack that unique selling proposition and value? And so for our clients that have gone through a full credit and income process before they write an offer, we issue with our pre-approval letter a second document that is a 17-day guaranteed close. The certificate, has our logo and says, the terms. And those are calendar days, not business days. And it says that if you accept this offer and we don't give the clear to close and send closing documents to the title company within 17 days, we will pay you as the seller, we will pay you $250 a day if we don't hit this 17-day timeline. And we've been beta testing that in kind of growing frequency for the last year. We've never missed a closing. And our clients tell us that it has been a massive differentiator in their ability to have an offer accepted versus 3 or 4 others that come in.
Wow. Now that's those kinds of what we call outrageous guarantees definitely tend to put businesses above and beyond their competition. So let's take a quick step back, okay? Because we did a deep dive kind of into your all's process with your company. But let's take a step back for the newbie. What is a physician loan? Why is a physician loan different than a conventional loan that they would get somewhere else?
Yeah, great question. So the biggest differentiators about a physician loan is that, let's take it from a kind of a macro viewpoint down. Basically, the lenders, because there's more than one bank that does these loans, but the lenders are saying, listen, we know that the probability of continued income and therefore payments on physician loans, they're also available to dentists. We have them available to veterinarians, even some CRNAs now. But the probability of continued income and therefore payments is higher with these medical professionals than just about any other subgroup in the country. So since we categorize these as lower risk, we're willing to make a separate set of guidelines that would not be the same guidelines like a conventional or a jumbo loan would have. And the main variations in those guidelines, the more liberal underwriting guidelines, as I call them, would affect a couple of key points. The first one is that they will go to higher loan to values and require lesser down payments. So for example, our company will do a 95% loan to value up to $1 million loan amount. So you can buy a $1,050,000 house and put $50,000 down and do $1 million loan amount. There's no mortgage insurance on that loan. And maybe I'm getting ahead of myself. That would really be the second point. But you can go to higher loan to values with less down. If you're in the lower price ranges, down around the $450,000 to $500,000 price range, you can do as little as 3% down. And all of those loan types are not going to have mortgage insurance as well. And I'll touch on that. But let me tell you some of the reasons why physicians should think about putting less money down on a mortgage, even if they have the ability to put more money down. Number one, most physicians that I meet, I think you're the exception, Eric, but most physicians that I meet are late to the game when it comes to contributing towards retirement because they're just trying to keep their heads above water to get through, grad school, med school, residency, fellowship, and they find themselves out the other end as an attending, now making good income, but it's hard to make up for that 10 years of lost in retirement contributions. So we've got some financial catching up to do. Most physicians graduate with a high level of student loan, and I see oh my gosh, not to mention just student loans now. I'm seeing consumer loans from SunTrust and all these online unsecured loan companies that I'm seeing just more and more debt coming out of residency, fellowship, and med school. So it gives you a chance to, even if you have more money for down payment, to pay some of that higher interest rate debt off. And as you know, it creates a potential tax deduction. You can write off the interest on your mortgage up to $750,000 under the new tax laws. So it gives you an ability to put less money down, have more money earmarked for retirement or more money to pay down liabilities. So that would be number one. Number two, you've got no mortgage insurance. Mortgage insurance is a premium that a borrower would pay each month to protect the bank in case the loan goes into foreclosure. So we call it a bad kind of insurance because it doesn't protect the person who's paying for it. It protects the bank. And it's not tax deductible in most instances. So it's very costly. It doesn't protect you and it's not tax deductible. So you're going to get around mortgage insurance in pretty much every physician loan that I know. And then in terms of the underwriting guidelines, Eric, they're more accommodating or liberal. So they're going to allow you to close on the purchase of a home without a paycheck stub in hand. A conventional loan requires 2 paycheck stubs. You got to have 30 days for the paycheck stubs before you can close. So it allows you to close on a future employment contract. Usually you can close somewhere between 90 and 60 days before your first day on the job. And it will have more liberal underwriting guidelines in regards to how it looks at your student loans for the debt calculations. And it's just easier to qualify for all around.
Perfect. That's exactly what we want. And then just a clarification point, can you explain at a first grade level what loan to value means?
Yes, thank you. So if your loan to value is the proportion of loan to the value of the home. And so what that would look like is if you bought a $1 million home and you wanted a $950,000 loan, you would be at a 95% loan, which is the 950,000, to value, which is the $1 million.
And for a typical loan, what is that normally the place? So the typical loans that people get out in the world, what is a typical loan to value that they have to stay within?
Yeah, typically you can do a 95% loan to value up to a $453,000 loan amount. These change, conventional loan limits change each year, but that's what it is today. But if you put down less than 20%, you have this forced insurance called mortgage insurance, and that's going to add on average about 1% to the cost of the loan. So if you have a 4.5% interest rate with 1% mortgage insurance, you're really paying like 5.5% for the first 11 years of that loan, which is about how long it takes for it to amortize down far enough, the loan to amortize or pay down until the mortgage insurance drops off. If you want to go into a jumbo loan, Eric, anything over that $453,000, then usually it's a 20% down payment. So if somebody wanted to buy an $800,000 house, they'd need a $160,000 loan with a conventional jumbo loan, as compared to a physician loan on an $800,000 house for putting 40 grand down.
Gotcha. Perfect. And that's where I was going to go next, was to ask to define a jumbo loan, and then how does the physician loan space work with jumbo loans? But you just answered that, so that's perfect. So let's talk about some special situations. So, well, actually, let's start with the process of getting a mortgage. So let's just say someone is a newbie. What advice do you like to give clients on the front end in terms of what they need to have gathered for you, but just to say any mortgage process? What is it that they need to be aware of and have document-wise?
I'll tell you what I'm going to do. I'm going to answer your question, but I'm also going to make a free copy of my ebook. So not a printed copy, but the ebook copy available to your members. And I will send you that email after the interview. You can put it in the show notes. Perfect. So if someone wants to get really, detailed in this thing, I've written a whole book on it. You can check through the chapter summaries and go right to the information that you want. But what I recommend that they do is, regardless of what lender they're working with, is that they insist on a couple things. Number one, you don't want to have one of those, "Hey, how you doing? Yo, yeah, no problem, Eric. We're good to go. We'll send you that pre-approval letter right out now." Don't have that conversation. It with a lender. It feels easy, but it is, like the sugar high that wears off and you don't feel so good. So you want to do a full application with the person that you're going to do your loan with. You want them to look at your credit. Everybody's worried about them looking at your credit. Look, credit is scored from 350 to 850 points. It is a massive scale. A mortgage inquiry is going to ding your credit 3 to 5 points. It is a drop in the bucket. Don't worry about it. You may not want to go out and have 20 of them pulled, and you may not want to have it in combination with opening a bunch more student loans and a credit card, but you have to have your credit pulled and have somebody actually tell you you're good, so that you don't get surprised that, oh man, I didn't think that medical collection or that AT&T bill was going to come back and haunt me, and now I don't qualify for a mortgage. You got to go through that process. Have them look at your credit, have the lender look at your credit, get them your income documentation. This is never more important than if A, you are starting a new job and you have an employment contract versus paycheck stubs, or B, you are self-employed or 1099 as an independent contractor. Those are huge landmines, massive landmines that people get burned at the last minute. So you want to get that documentation to the lender as early as humanly possible. And then you want to talk about your liquidity. How much cash do you have? How much reserves will you have post-closing? Because every bank has a requirement about that. And then once you've given that information to the loan officer and the loan officer said, hey, that looks good, you should insist that an underwriter looks at that data. Hey, Eric, I appreciate you looking at my documentation. Thanks so much. I'm glad that I'm pre-approved. Do me a favor. Can you have your underwriter review my employment contract and liquid reserves and just make absolutely certain that there's no landmines hidden in there? And if you insist on it, usually a lender can get that done for you.
Perfect. Now, can you define what liquid reserves are and what can be used as liquid reserves?
Yes. So if you put 5% down on a $500,000 house, okay, we'll call it $25,000. And then let's say that you've got $5,000 in closing costs. So your cash to close is going to be $30,000. In addition to that, most programs will require that you have between 3 and 6 months liquid funds as reserves, and 3 to 6 months worth of payment. So let's say your payment on that $500,000 house is, well, let's just say $3,000 a month. So they're going to want to see that after you bring in the $30,000, which is your 5% down plus your closing costs, you're going to have somewhere between $9,000 and $18,000 left over in liquid reserves. So post-closing, you have a little bit of liquidity. Why? Well, if you're closing on an employment contract, you're not going to get that income for a couple months. And oftentimes, underwriters know that when you buy a house, your spouse, I know my wife is guilty of this, they decide that all of your furniture sucks and you're going to need brand new furniture for this house and moving expenses. I mean, there's moving expenses. And so they want to see that there's some liquidity there so you don't run into a cash crunch. I think you had one more question, and I think I lost it if I didn't hit it.
What can be used as reserves?
Yeah, that was it. Thank you. So every bank is a little different on this, but typically you can use a retirement account up to 70% of the value. So if you got $10,000 in a retirement account, you can count 7,000 of that towards the reserve requirement. Of course, the CD can be used fully. Any cash. Some programs will allow you to even receive a gift from a family member to satisfy that reserve requirement. Any brokerage account, you can use the full 100% value. Retirement accounts are discounted by about 1/3.
Gotcha. Perfect. So now let's move into, I think we've done a great job of giving an overview of what physician loans are and what the process is of closing through them. Let's now talk about some special situations when it comes to buying property. So let's talk about condominiums and kind of how they're viewed in the lending world. I know a lot of physicians, if they're in medical school or residency, like I bought a condominium when I was second year medical student. And so I know that there are some special situations when it comes to condominiums. How do banks and underwriters look at condominiums?
When the financial crisis and mortgage meltdown happened, there was virtually no segment of the mortgage market that was hit harder than condominiums. So the first thing you should know is this isn't about you. It's nothing personal. There were entire buildings in Las Vegas and Seattle and San Diego and Miami and Florida, that, literally lenders lost hundreds, if not billions on a single building. So they came up with these pretty restrictive guidelines that said, all right, essentially what they say to you is, Eric, I have to underwrite you as a borrower. And even if you are flawless, I also have to underwrite the HOA. I want to see that they're allocating some money each month towards reserves. The guideline is 10% of the HOA budget needs to be allocated for future reserves, because they know if you're not, right, if you're not putting 10% away for capital improvements, you're going to have a capital call, right? The HOA is going to have to do a special assessment at some point. So they want to see that the HOA is planning ahead. They want to see that there's a certain number of HOA members are not greater than 60 days delinquent in their HOA fees. They want to see that one investor doesn't own greater than 10% of the HOA complex of the units, because if the one investor goes down and they own 20%, you pretty much tank the values for the entire project. So there's a condo questionnaire which is sent to the homeowners association that needs to be filled out, and then depending on the loan type, they will ask for budget, they'll ask for CC&Rs, they may ask for the minutes from the last 2 HOA meetings. They'll ask if there's any pending lawsuits. I mean, it's a financial oscopy on the HOA to get that approved. So what's the takeaway? No, plan for a little longer close on a condominium because there's more due diligence, and know in the back of your mind there is a potential that there's going to be a problem to buy this condo that has nothing to do with you. So you better have a backup plan for your family. In other words, if you're selling your house and you're out and you're going to have the U-Haul packed up and you're driving across the country, and if that condo loan doesn't close on time, you're SOL, you need to have a backup plan. Like if that happened, I have an extended stay, it's all good. Just plan ahead for your family.
Got it. And you said CC&R, what does that stand for?
Oh, thanks. You're so good. Covenants, codes, and restrictions. So every condominium, planned unit development, what's the other one that co-ops, they're all going to have these mutually binding agreements that governs how the association or the condo association is going to operate. So can you have dogs? Can you have a barbecue on the deck? Can you turn your condo? Yes. Can you rent your unit? Yep, that's right. You got it.
Perfect. And so condos, just put in the back of your mind that you may have to, that they're not just going to underwrite you, they're going to underwrite the building as well and the association as well. So it's multiple step process, and you need to have a backup plan potentially in place. second kind of situation that comes up a lot is the whole rent versus buy while in medical school or residency or fellowship. So you're not an attending, you may be in a space for a certain amount of years. Now, granted, I know there are a lot of variables, but what, as a loan officer who's done probably thousands of loans and has seen situations, where do you come down on, or how do you think about that thought process, I should say?
Yeah, I was just having this conversation yesterday, and I think the answer is it depends. Always, right? If the decision is being made in San Francisco, then I would probably give the advice that it's going to be. So here's the factors. How affordable is the area you're going to buy in? Is the payment that you're going to pay for a mortgage affordable and reasonable? And are you not stretched so thin that if, God forbid, something happens to a family member, or you're out of work for a little while, or something that you didn't anticipate happens, no problem. I've got a flush fund. I'm living below my means. We're good. I can still take a vacation, or I can still have some meals out. If it's comfortable and affordable, then I think that's one very strong indicator that you might want to look into buying. If it's not on the buy side, just rule it out. Just don't stretch yourself to the point that everything has to go right in order for you to make your mortgage payments on time. That's a bad situation to get into. So when you talk about that decision in San Francisco, it's probably a better idea to just rent. And if you got some extra money, invest elsewhere. Okay, now the next consideration. How is the market doing? Is the economy that you're buying in vibrant and expanding with a low unemployment rate? Or is it, like we could use the illustration of Detroit a few years ago, as the car industry kind of left, the commerce just kind of dried up. So just be aware of what's going on. Are there businesses moving in or moving out of where I want to buy in? And I think the last consideration has to be, how long are you going to be there? If you're going to be there for 24 months, everything has to go right for that to work out for you, or you have to plan ahead that I'm rolling this into an investment property, which I think could be a great strategy. But you don't want to put yourself in the position that I may have such a short window that it has to go up in value or I'm in big trouble. If you have a 4, 5, 6, 7, 8, 9, 10-year period where you could hold the property, then even if you time the market wrong, time forgives all in real estate. And I'm so gracious for that because I've made a lot of mistakes.
Yeah, that's what I always tell people. Like, if you can hold on to the mortgage, just wait. It will come. You will be
That's
fine
right.
eventually from that standpoint. And so
Right.
I know on our end, when we're talking to investors and other people that we're just advising about kind of this buying during a window of time where you may not be there an extended period of time, is to go into looking at the real estate as almost an investment, not as a retail buyer from that standpoint, meaning you have to understand what the market is doing. You have to understand the market fundamentals. You don't have to become an expert, but pretty well, you can pull up the Bureau of Labor and Statistics and see are people moving in and moving out, or jobs being created. You can Google kind of U-Hauls in and out, kind of migration in or migration out. These are all easy things that you can do. And if you get a good agent in that particular market, they can show you the history of the market in terms of pricing in that way. And then I always say, put in the back of your mind, if you had to rent this property, is it at a price point where renting will at least allow you at the very least to break even, which, I'm not necessarily a fan of, but, it may, some people will do it at the very least break even if you had to rent it. And so that's kind of how we look at it from kind of the investor standpoint, that side. And it's pretty much echoes kind of what you're saying from your standpoint as well. And so let's just kind of open it up now. I think we've gotten through most of what I wanted to do for kind of a basic understanding of these situations. So what didn't I ask you? What is it that you want to convey to an audience that, let's just say, is new to the physician mortgage world? What is it that they need to know from your experience?
Yeah. If I was out there looking for a physician lender, what I would want to see is that the person that I'm talking to on the other side has had a vast experience with dealing with physicians and can sense the problem before it becomes a problem, because they've been down this path with hundreds or thousands of physicians in the past. So I would encourage folks to not be intimidated to ask questions deeper than what is your rate. The question that should also be asked is, hey, let me ask you a little bit about your clientele. Could you provide me with 5 to 10 physicians that you've done loans with in the last 90 days? And would you mind if I reached out to one of those, or could you see, if we could speak to them, or do you have testimonials? Or if I Google your bank and client mortgage reviews, what do they look like? What do people on Google and Angie's List and other sources, what are they saying about that mortgage professional and their company? Do they close late? Is closing a nightmare? Are they stuck in a U-Haul van because the loan wasn't closed on time? You really want to think through those things, because an eighth or even a $0.25% difference in rate, yes, it's 17, 25, 50, 60 bucks a month. It's not inconsequential. But trust me, being homeless with children as you're supposed to start a job is worth 20 bucks a month. So you want to think through not only what kind of products do they have, but what kind of reputation and history do they have serving physicians. I think that is drastically overlooked and something that should really be thought through.
Okay.
And just to parallel on that, I think there should be a similar due diligence done in the picking of your realtor. So a mistake that I'm seeing people make a lot, and this is especially costly in today's market because the competition for housing is near all-time highs, but they will go on to Zillow, which I need to say something about that before we get off, but they'll go on to Zillow and they will see someone who's positioned as the neighborhood expert and click them and assume that this person has some kind of expertise. The reality is that Zillow and Realtor.com and Trulia are media companies, and their revenue model is to capture your information, to sell it to as many realtors and loan officers as possible, and then for the realtor that says, hey, I'll pay you X number of dollars a month, and we're talking thousands of dollars a month, Zillow will make them into the area expert. That has zero to do with their ability to give you good advice or to advise you. And especially when you're relocating across the country, you want someone who knows the areas around the hospital systems, knows the drive times, knows the schools, knows physicians in the area, and has served physicians before. So spend a little more time in due diligence and going deeper than they look good on Zillow and their rate seems to be the lowest, because that is a recipe for being homeless on the day you're supposed to close on your house.
Got it. Do you have any tips about choosing an agent?
Yeah. What we have figured out, because we struggled with this, trying to match up good realtors, we partnered with a local realtor that is a broker for Berkshire Hathaway Home Services. And he has literally gone out across the country and has found a bunch of realtors in major metropolitan areas all across the country that have family. I mean, their spouse is a physician, their father's a physician, their brother's a physician, and they know these markets that local physicians live in, and they deal with relocating in and out physicians all the time. And so he's gone out and he's put together a pool of these realtors across the country. Anybody can reach out to me at any time, and I can make an introduction to somebody that we've done business with before that has served physicians pretty much anywhere in the country.
Okay, perfect. That is absolutely helpful. Any closing thoughts from informational standpoint? Because after that, I'm going to let you kind of do a nice commercial for your company and how people can reach you. But any more informational closing thoughts before we move there?
I'm a little intimidated about the commercial. We'll see how I do. Let me just leave you with one maybe closing piece of advice. Finding a house in 2018 and getting your offer accepted is difficult. If you don't have the right tools to actually look at the market and educate yourself, see how fast homes are selling, and get yourself acclimated to the price points and what you're going to buy, it makes it exhausting to find a house. I recently discovered that Zillow, Trulia, Realtor.com, as I mentioned, these companies are not real estate companies, they're media companies. And why that distinction is so important is because media companies don't have a live feed into the MLS. It's called an API feed, which is a live insertion into the multiple listing services that gives them live data. What they buy is a copy of some of the MLSs, so they don't get all the properties, on delay. So I was recently at a seminar and I watched them do pulled up the live MLS from a realtor login as compared to what was on Zillow. The discrepancy rate was 47%, meaning that 47% of the data on the MLS was not accurately on Zillow. Said another way, you're wasting 47% of your time, or you're informing yourself with 47% wrong information. I had a client just the other day say, I'm looking at a home on Zillow right now. It says it's active for sale, but I called the realtor and they said the home closed 3 months ago. And so as a buyer, if you think of all that false information that's being fed out into the market, you're now thinking that the price that you paid for homes 3 months ago is the same price for homes being paid today. So you're miseducating yourself with bad data and wasting a tremendous amount of your time. So I'll also give you guys a link to an app that our company pays a tremendous amount to have a subscription to. It's a live feed into every MLS system in the country, because the company who owns the app, the house hunting app, actually is a real estate company. So they have live access to every MLS. We don't sell your information. It's all private. And you have that live feed, so you get to search for homes exactly like a realtor would. So that's my last piece of advice. Just make sure your mechanism for educating yourself is live data, not solely through one of these media companies.
Wow. I mean, that alone, if you just offer that to our listeners, that value is through the roof. And as someone who is a real estate investor, getting access to MLS data is like the holy grail for us, live time in that way. So, I did not expect that. Thank you. I appreciate that. Appreciate that immensely. And so let's roll out your company. We'll put all this information in the show notes as well. But for those who are audio who may not have the ability to get the show notes, go ahead and tell everyone how they can reach you and get in contact with you. Tell us about your podcast, all of those things.
Okay, great. Thank you. So you can reach us at probably the best website would be fairwayphysicianhomeloans.com. You could also just Google that. The book website is whyphysicianhomeloansfailed.com. I'm also going to give you another super secret link that you can go in and just pull down the ebook if you don't want to pay for the paperback version. And I'll also give you our podcast is the Physician Financial Success Podcast. You can just put that into iTunes, Physician Financial Success, and you can find that there. And as I said, I'll give you the link for the Home Scout app. That is the app that gives you a live API feed to every MLS in the country. A little bit about Fairway. I'll be brief. I don't want to bore anybody to sleep. Fairway Independent Mortgage is a company that is built around 10 core values. And what I think is unusual about Fairway as compared to other companies is the entire organization is actually run with integrity to these 10 core values. And one of those that I think is most important to a consumer is speed to respond. We also like to have fun. So when we go through the mortgage process, we're sending gifts and doing fun things to clients to surprise them. As soon as somebody goes under contract, Eric, we send some stress-free tea via Amazon next day to their house. And we say, hey, enjoy the stress-free tea. Turbulent flights land safely 99.9% of the time. We got this. So we do some fun stuff like that. But the speed to respond is really the differentiator with this company. And that runs from the executive team and the CEO all the way down. So if I need something as a loan officer or director of physician lending, I get a response like that, which enables me to give a response to my clients like that. So I'd say that's the big differentiator with Fairway. We're the fifth largest retail mortgage company in the country. So it's Wells, Chase, Quicken, Bank of America, Fairway. So big company, have access to pretty much every program that is imaginable.
Perfect. That, I think, sums up everything perfectly. And just for people who are listening, Josh spells his last name Mettle. So if you want to be able to Google him, you can. So Mettle. So I want to thank Josh Mettle for being with us today on the Path to Wealth. Again, he's the Physician Group lead at Fairway Independent Mortgage, and he's Director of Physician Lending. I want to thank you all for listening to the Physician Road podcast today. Please go to iTunes or your favorite podcast platform of choice and subscribe so that you can get our latest episodes. Please also at iTunes rate and review our podcast. 5 stars are best, of course, so that we can have more physicians find us. Lastly, you can go to thephysiciansroad.com to find our guides and resources. Thank you for listening again, and we will see you next time on the Physicians Road, where you create your life in medicine.
The Physicians Road is brought to you by Vernonville Asset Management. Vernonville Asset Management was created to help physicians build wealth and create income beyond Wall Street. Through our exclusive private investments, doctors can begin to free themselves from the burdensome regulations in healthcare by creating income streams independent of medicine. Go to incomebeyondwallstreet.com to get your free report, Wall Street's Biggest Lie. Again, go to incomebeyondwallstreet.com to get Wall Street's Biggest Lie and free yourself today.
Thank you for listening to The Physician's Road, where you create your life in medicine on your own terms. Please go to thephysiciansroad.com and sign up for your free guides and resources.